In this video, we're going to talk about money management, which is one of the most important lessons we can give you over the course of this video course. So please don't skip over this one. Pay attention to this one because this is what's going to save you in the long run. And this is what's going to keep you in the game long enough to be able to benefit from the edge of your system. So the reason I said this lesson was so important is it's one of the biggest reasons that traders fail. And that's to do with poor money management. You see, what we're doing as traders is that we're taking educated guesses, we're taking calculated risks to make money from the FX markets. That's what we do as traders. What we're not doing is we don't have a crystal ball, so we're not taking 100% trades where we're going to be right every single time. And it's really important to understand this, because at the end of the day, the traders that fail, they don't necessarily fail because they've got a bad system or they're bad traders. They fail because they take way too much risk for their particular account size. They have dreams of what they can do when they win all of this money, but they don't really pay attention to what happens if they lose a trade, or if they lose 2 trades in a row, or 3 trades in a row, or whatever it is. So ultimately, you need to understand that as a trader, the key to trading is living to fight another day. Because you need to understand that we can't control the markets aren't going to do what we want them to do. The best thing that we can do is put ourselves in a position to be able to profit from the market when it behaves the way that works for our particular system. Remember that the market can do one of 2 or 3 things. So it can either trend, it can either go through a consolidation period, or it can reverse. All right, now that means that if we're trading a trend following system for 1 or 2 of those periods, we're not going to be making any money. So what we need to do during those periods is limit our risk to make sure that we're not losing a great deal of money, so that when the market does start to trend, we're there and we can take advantage of it. Now imagine if you're taking risk that's way too large for your account size. So let's say you're taking like, I don't know, 5-10% risk. If you have 5 or 10 trades in a row which lose you money, you can pretty much, wipe out your account. If you're taking 10% risk, which I know there are some people that do that out there, 10% risk means 10 trades later, you don't have an account left. And if you don't have an account left, it really doesn't matter how great your system is, because you don't have money to put at risk to make the profits that your system can produce. Okay, so it is very much about staying in the game. Get ready to fight another day. You almost have to think like a casino. Okay, you have an edge in your system. Your system gives you, X% over and above the market. So over, 100 trades, each trade is worth to you point something percent, or whatever it is. You've ultimately got an edge in your system, but you need to think like a casino. So if you think of a casino's roulette table, on any given spin of the wheel, the punters, the people that are betting, they can win, right? So if you put your money on, I don't know, red 31 or black 32, whatever it is, on any one spin of the wheel, you could be lucky enough and you could win. However, sit at the table long enough and the casino will take back all of its money and then some. You see, the casino understands that it has an edge over you. So even though on any one given spin of the wheel you can make money, if you sit to the table long enough, you will lose all your money and you will give all of your money back. So the casino isn't bothered with any one particular spin of the wheel, because it knows it has enough capital to ride out those bad times. And there will be times when the people that are betting will go on winning streaks, but that's fine. You know what the casino does when a punter goes onto a winning streak? That you give them free drinks, you give them free accommodation, they give them free this, free that, all in a bid to make them sit down to the table long enough, because they know that over a long enough period of time, the casino's edge will play out and they will make all of their money back. And that's how you need to think about your trading. You're not bothered with the outcome of 1 trade or 2 trades or 3 or even 4 or 5 trades. You're concerned with the outcome of 10, 20, 30, 40, 50, 100 trades. That's what you need to be concerned with, because that's when you'll see your edge play out. So let's say, for example, you have a system that will be right 60% of the time. That doesn't mean that over 10 trades, 6 of the trades will be right and 4 of them will be wrong. No, it could mean that all 10 of those trades are not profitable. And then you move into 20 trades and 20 trades aren't profitable. But then after those 20 trades, maybe then you start to hit the streak, and that's when you see your 60% play out. So what I'm trying to get to you here is, I'm not saying that you're going to hit loads of losing streaks. You need to be mindful of the fact that you can go on a losing streak. So you can't tailor your money management according to you being right on every single trade. You need to assume the worst case scenario and then double it. So for example, with our systems, we know that from back testing and from forward trading them, live trading them, we know that we can expect a drawdown of 6 to 7 trades. Okay, it doesn't happen often, but it's happened once or twice before. So let's say we assume 7 trades as the worst case drawdown. We'll then double that and we'll say, okay, so maybe we can have 15 trades drawdown. Highly unlikely, but it could happen. So if we can have a 15 trade drawdown, we don't want to tailor our money management where we're risking, 5 or 10% on each and every trade, because we will kill ourselves after that drawdown. What we want to do instead is determine a risk profile which will suit us as traders, but also suit our system. Now, what do I mean by suit us as traders? Because I've just thrown a complete other factor into the mix here. Well, ultimately, let's say, for example, that we take our risk profile and we say that 15%, or we say that you can get the 15 trade drawdown, okay? Now, with a 15 trade drawdown, we can do basic mathematics and we can say that you can take at least kind of 5% risk per trade, and you'd still have some of your capital left at the end of the day to be able to take the next trade. However, what does that actually mean? If you think about that from the perspective of you as a person, you as a trader, 5 times 15 is 75, right? Now, if you lose 75% of your account, do you really think you will be able to take the next trade? I highly doubt it. Okay, because you need to understand, as people, we have 2 sources of capital. We have our monetary capital and we have our mental capital. Now, even though monetary capital wise, we would still have enough money to take the next trade, you need to understand that your mental environment will be completely destroyed at that particular point in time. So you need to think about that as well. That's why you hear a lot of people say don't take more than 1% or 2% risk per trade, because it's not just thinking about the system itself, because we all know that a system can survive more than a 2% risk per trade. But what we're actually thinking about as well is, how will we feel as people? How will you feel after taking a 15 trade losing streak? Now, if you were risking 5% risk per trade, that's 75% of your account, you're not going to be happy. If you were risking, let's say, 1% of your account, you'd be 15% down. You're also not going to be happy, but it's not the end of the world, because it's only 15% of your account. It's not 75%. Do you see what I mean? So there's a huge difference there, and that's also something that you need to factor in when you're thinking about your particular money management rules. Now, the other thing is, we also like to have a positive risk reward ratio. Now, this isn't always going to be possible, and I'll talk to you about that on the next slide. But the thing with a positive risk reward ratio is it allows you to be wrong more often than you're right and still come out ahead of the game. So what we like to do with all of our systems is that we start with kind of like a 1-to-1. So we're looking for 1-to-1 risk reward, but ultimately that's our first target. If the market then roars off and gives us more, we're happy enough to take that. But I'll talk to you more about that in the next slide, so don't worry. And lastly, we need to have realistic targets. Now, that means you're not looking to make 100% a month. You can't do, well, you could do that, and people do that. But you know what? If you're trading at that sort of level of risk, you're going to wipe yourself out. So you may make 100% one month, 100% the next month, but there will be a month that comes along and you will have a catastrophic loss and you will wipe out your entire account. So if you have realistic targets, you're going to be less tempted to take larger risks on any one particular trade, and that means you're going to be more likely to stay in the game long enough to make money from the markets, to see your system's edge play out. Okay, now realistic targets from our perspective, if you're looking for somewhere between sort of 5 and 10% a month, that's a realistic target. Will you do more than that some months? Yeah, sure, why not? But if you're looking for kind of 5 to 10% a month, that puts you in a good bracket. That makes you double your account almost every year, but it also ensures that you're not taking excessive risks on any one particular trade. So the risk reward debate. Now, just now I said that you want to try and have a positive risk reward, and that we believe, and we will stick by that. However, I want to talk to you about the positives about having less of a risk reward. So not having a negative one, but maybe only having something like a 1-to-1. Now, before I do that, I want to state that on various studies and tests that we've done, we've proven that a greater risk reward often leads to greater profits. However, you need to understand that a greater risk reward and greater profit has a direct impact on your strike rate. So think about this logically. If you're going to look to make more on any one trade than you lose, the market has to go further. If the market has to go further, it's more likely that the market will hit your stop loss before it hits your target. Okay? Now, the reason that I put this to you is that if you're the type of trader that needs to be right, having a greater risk reward may have a negative impact on your bottom line. So even though in our various studies and tests we've shown that having a greater risk reward offers greater profits, if you're the type of trader that has to be right, then you're less likely to be able to trade a system with a lower strike rate, and you're more likely to make mistakes, make rash decisions, and all of that kind of good stuff, which ultimately will mean, even though our studies and tests have proved one thing, you as a trader trying to trade a system with a greater risk reward, actually you do exactly the opposite. Right, now why is this? Well, if you think about it like this, with a higher strike rate, you have less of a drawdown, okay? And hence, with less of a drawdown, your psychological environment is less likely to be impacted. And if it's less likely to be impacted, you can afford to take bigger risks on positions, okay? So let's say, for example, you're trading a system where you have, you gain 2 for every 1 that you risk. That's fantastic, but you're only right 50% of the time. All right, so you're going to be making money, no doubt about that. But what if you're trading a system where you're right 70% of the time, but for every 1 you lose, you make 1? Now, in reality, your results from the other system, the one with the greater risk reward, will probably bring you out ahead of the game in the end. However, you as a person, your mental environment will be shot trading a system where you're only right 50% of the time, because that means that you're more likely to have deeper drawdowns than with a system which is right more often than not, but you kind of just take less of a profit when you are right. Now, the reason that I put this to you is that I personally am one of those types of traders. My brother's completely the opposite. So my brother can take trades with a very, very low strike rate, and he's happy to sit there and take loss after loss after loss after loss, and then come out ahead of the game because his winners are massive. Whereas me personally as a trader, I'm the type of person that I do need to be right more often than I'm not, because I make stupid decisions when I'm not. So the systems that we teach are kind of tailored towards that sort of trading. Although you can go for the bigger profit targets, they also allow you to be right more often than not, but make less of a profit. Okay, so as I said, the reason that we're putting this to you is that we know the impacts of it, and we're trying to open your eyes to it. It's something that you really need to think about, because in the long run, I promise you, it will have very, very positive impacts on your trading if you choose the approach that's right for you. So we've talked about risk and what it means and all of that, but what about calculating risk? What's the right amount of risk that you should take on any one trade? Well, the maximum, in our opinion, you should be risking on any one trade is 2% of your accounts. Okay, in reality, we take 1% or even less than 1% sometimes per trade. But I know a lot of retail traders are a little bit more, or they're less risk averse than we are, and they like to take, more on any one trade. So that's fine, but we would still say that you don't want to take any more than 2% risk on any one trade. So what does that mean? Well, if you have a £10,000 account, then the most capital that you can have at risk on any one trade is £200. Because £200 is 2% of £10,000, okay? So what that means for your position size is that if you have a 50 pip stop loss, then you can only trade £4 per pip. Now, it's important that you understand this, because you don't just choose a particular position size and let's say it's £5 per pip and use that no matter what your stop loss is, because then you won't have a consistent risk profile. So you won't be consistently risking 2%. So let's say, for example, you risk 2% on a trade and you have a £5 per pip trade size, okay? If that's your trade size and you're trading at a 40 pip stop loss, then you're fine. You're in your 2%, £200. However, if you trade £5 per pip and you have a 100 pip stop loss, then suddenly you're doing £500 per trade, which is what? 5% of your account. Okay, so you need to have a consistent profile, consistent risk profile, which means that you decide on a percentage per trade, and then you work out your position size according to where your stop loss will be. Okay, so the calculation for your position size is your account balance, okay, times your percentage risk, and you do it the decimal way. So our account balance is £10,000 and we want to risk 2%. We would do 10,000 times 0.02 divided by what the stop loss size is. So here we're assuming a 50 pip stop loss, and that will give you your position size, which is 4. So now you know that for your particular trade that you're taking with a 50 pip stop loss, you can trade a maximum of £4 per point. Does that make sense to you guys? So determine what your risk profile is, determine what the maximum amount of risk that you're willing to take on any one trade. All right, then you get your stop loss, you find out what your stop loss is going to be, you plug in the calculation as below, and you come out with your position size. But don't deviate from this. Don't start to do any martingale strategies or anything like that where you take one loss, so that means that the next trade that you're going to take a bigger position size or something stupid like that. Okay? If you have any questions, as always, please feel free to post them in the video below and we will endeavor to answer them as soon as possible. So in conclusion, never risk too much on any one trade. It's absolute suicide. Please take it from us. You do not want to do it. We've been there. We've done it before. Okay, I'll tell you a little story actually. When we first started trading, maybe 8 years ago now, nearly 9 years ago, when we first started trading, we heard about this strategy to trade the news. Okay, we heard about this thing called the non-farm payrolls where the market moves 100 pips in one direction, guaranteed. Fantastic. So we did this thing called straddling. And what that is ultimately you place a trade or you place an order to open on each side of the market. And whichever side gets triggered, happy days, you make money. The other one, you just take it out. So we did this 1 month, and I kid you not, we took £500 and we turned it into £4,500 in the space of about 5 or 10 minutes. So we sat there rubbing our hands together thinking, you know what, we've made it, we're onto something. We'll just do this again next month, and then the next month, and then the next month. And you know what we did? We took that £5,000 the next month and we put it all onto the same strategy. 100% of our money. Imagine that. How stupid is that? Anyway, that particular month, we got a one of the revisions of the non-farm payroll the previous month was massive. So it was a big surprise to the market. So the number was one thing. It sent the price one way. We entered into our position. The revision just then came out. The revision then came out and sent the market the other way. So we're entered in these two positions, which you would say is hedged. But we exited one position, we couldn't get out of the other one, okay, because of the volatility of the news, and we ended up trading that £5,000 account into about £300 or £400 in the space of 5 minutes. So as quickly as we made that money the month before, we threw it all away the very next month because we didn't understand money management, because we didn't understand that actually you don't need to be risking everything on every single trade. It just doesn't make sense to do that. Okay, so never risk too much on any one trade. If you can, look for a positive risk reward ratio. Now we've just spoken about the positives and the negatives of this, so you need to decide what's right for you. But if you can, try to trade the system so that you're getting more when you win than you lose when you take a loss. Okay, have realistic expectations. 100% return every month is not realistic. Even though some months you may achieve it, there'll be others when you completely wipe out your entire account, and you don't want to do that, believe me. And remember that you don't need to hit a home run every single time. If you have a risk reward ratio of, let's say, 1.5 to 1, all right, so you make £150 for every £100 you risk, for example. At 2% risk, all right, you only need 50 trades of 100 to be successful. 50 trades of 100 to be successful and you'll make a 50% return. All right? Which is a significant return. Now let's think about that for a moment. Every £100 you risk, you make £150. So over 100 trades, the 50 trades that you lose, you will lose £5,000. Okay? If we're risking £100. So you've lost £5,000 from the 50 trades that you lose. However, of the 50 trades that you make money, you're actually making £7,500. All right, so you're making 50% return. All right, well, let's do it another way. just so you can really understand and own this theory here. You're risking 2% per trade, okay? So over 50 trades, you will lose on 50 of those trades that you will lose 100%, okay? However, you will make 3% on the trades that you make money. So over those 50 trades, you will make 150%. 150% minus 100% is 50% return. Okay, so just think about that. Think about that very, very carefully, and I'll leave you with that thought there. If you can just get to a point where you can take 1.5 times out of the market what you risk on any one trade, then after a series of 100 trades, you will have made yourself a 50% return. If you can do that in a year, you're a superstar. Okay? So as I said, you need to be aiming for kind of 5 to 10% a month, and that will put you in a really, really good position for the future. And that will ensure that you're not risking too much on any one trade, but you're also putting yourself in a position to grow your capital substantially. So thank you very much for watching the video. If you need to watch it again, please do. As I said, it's a very, very important one. And if you have any questions whatsoever, please feel free to post it in the video below. I'll speak to you soon.